Three, two, one, and we're live. Welcome to another episode of Hot Coffee Consulting, the Roundup, where myself and Matt Taylor will be taking you through all of the latest news, articles, press releases around data and technology, and giving a roundup with respect to our analysis of the hot topics in the industry. Today we've got 3 or 4 topics that we want to talk about. So we're going to start with a story around S4 Capital, the Martin Sorrell agency that is looking to invest in first-party data assets. Then we're going to go on to talk about the AddThis business and the deprecation of AddThis by the Oracle Data Cloud in Europe. We're going to then talk about location data, which seems to be a very hot topic in the industry right now. And finally, we're going to end with a story on Google and the change that they're making to their auction mechanisms, changing from a second price auction-based system to a first price auction-based system. But before we begin with that, introduce my co-host, Matt Taylor. Welcome, Matt.
Good to be here, Miles. Thanks.
So let's kick off. Let's talk about S4 Capital. So this is Martin Sorrell's new agency group, and they are looking to make investments into the first-party data ecosystem. So article in AddExchanger published March 19th, S4 Capital on the hunt for a first-party data company. Martin Sorrell says, "We would like to lay our hands on sources of first-party data, but it's not easy. There are some, but valuations are high." And I think, this, generally speaking, follows a trend by media agencies to get more invested into the data ecosystem. We saw that with IPG's acquisition of Axiom. We saw it with the Dentsu Aegis acquisition of Merkle. And it seems that Martin Sorrell is following on that trend. Any thoughts on that, Matt?
Yeah, I think there's a clear narrative there that agencies are looking for more robust data and looking to be more transparent with their clients. And in the wake of all of the press at the moment about businesses struggling with providing that level of transparency with third party, it means that Martin Sorrell has that view that he can go out to market, push that with clients, and win more business.
I mean, it certainly seems to be that agencies have identified data as being one of the key strategic assets and differentiators. What's interesting is that a lot of the different groups and key agency players have quite different approaches. So I mentioned IPG and Dentsu Aegis that seem to be acquisition-based approaches to data. You've got WPP, a lot of their capability being proprietary or acquired as well. So KBMG Group, iBehavior, Turbine, and Platform. And then you've obviously got Omnicom Media Group with the development and delivery of Omni, which is mostly a partner-based approach to the data ecosystem. So different models. It'll be interesting to see which of those models has most success in the future. Okay.
I think just to add also, he goes on to mention about how they're looking to go back to how media was in the 90s, which is quite a good thing, or an interesting point that he talks about, where they're looking to combine creative and media buying together. So as opposed to this diluted mix of going to the creative agency, then to the media agency, and having all these different fees in place, he's looking to negate that. And it comes back to having a clear differentiation with data and the overall strategy there to win clients.
Yeah, absolutely. Okay, moving on then.
Great, so let's go on to our next article here. Article in AddExchanger, written on Monday, about Oracle Data Cloud killing off its AddThis audience business in Europe. So key topic for this, the key point is that they've completely sidelined that part of the business in the wake of GDPR. The key thing is anyone who's gathering legitimate interest data without consent means that it's a murky world, essentially. It's saying here for Oracle, it's saying that based on the acquisition of Moat and Grapeshot, there's other focuses in the business such as contextual targeting, which seems to be growing hugely. And if we look at a key quote here from Eric Rosa, who's the GM, he says that, just get to the point, he says, in Europe, we took a much more conservative position than others, partly because Oracle needs to be more conservative. We've got a 180 billion market cap, and we're not going to be the poster children for this. So I think it's really interesting, just to say that they're shelving that, but I think by any means it doesn't mean that Oracle are going to be declining as a business. They're just focusing elsewhere. What are your thoughts on that, Miles?
Well, obviously, when he says we're not going to be the poster children for this, this that he's talking about is the General Data Protection Regulation. Oracle's in an interesting position, as you mentioned, $180 billion market cap. A very small proportion of the revenue that Oracle drives as a business comes, first and foremost, through Europe. Secondly, through AddThis as a data exchange. And so I think this is just a case of good business sense. There's a lot of risk. There's very little potential reward for continuing with the AddThis business. I do think that there are some quite deterministic, quite defeatist opinions in that article around the third-party data ecosystem in general. And I think that, causality is something that we need to take into account when we look at this. So you mentioned the acquisition of Grapeshot and of Moat, and Oracle have diversified their position, preempting the incoming regulation, making it a lot easier for them to divest certain assets that they may have. And I think this is less a case of AddThis not complying with the General Data Protection Regulation or not being able to be restructured in a way that it can comply with the General Data Protection Regulation. I think it's actually more a case that Oracle have not deemed it necessary, not deemed it worthwhile an exercise to restructure the relationships that they have with publishers and ensure that they have consented data. That isn't something that is necessarily replicated across other data exchange businesses. We've seen dozens of data exchanges, third-party data exchanges, that do believe it's worthwhile to restructure their contractual relationships with their publishers and their supply partners. We've seen a restructuring and rebalancing towards consent as the main legal basis for processing. And so I think that it's probably good business from Oracle's perspective. I think that clearly having AddThis deprecated and not available in the market is a net negative. And I think that, generally speaking, there seems to be a glibness in the article and around the commentary surrounding the article around the demise of another third-party data provider on the basis of the General Data Protection Regulation. And I think that's probably unwarranted. And I think that, generally speaking, what we want to have is clearly bad actors identified and brought to task, brought to some sense of justice. But what we also want clearly is more opportunity, more competition, better prices and better quality. And I'm not necessarily sure that when businesses that simply deem it to not be a worthwhile exercise to adhere to the General Data Protection Regulation pull out of the market, that is going to be the ultimate end game.
Yeah, it can easily be viewed as doom and gloom for businesses like Oracle, but the reality is it's just a shift in their business strategy, and they're just negating any risk possible.
Yeah, absolutely.
Yeah.
Okay. So moving on then to an article that was published in AddExchanger March 13th, I think in their column piece, Data Driven Thinker, the economics of inaccurate location data. This was written by Mark Slade, CEO at Location Sciences. This is following on from a trend that we've seen over the past few weeks of people across the industry commenting on the inaccuracies and the fraudulent activity within location data services. And what it basically says is that we have an ecosystem that is inherently incentivized towards the provision of location data within bid requests and within other auction mechanisms without having really necessarily the supply of that location data, and that leads to fraudulent practices where publishers, for instance, claim to have quite accurate location data, but actually, in reality, don't. There was an article that was published a few weeks ago in DigiDay that was very similar. It was talking about the way in which the location data ecosystem is built principally on data signals, location data signals that may not be accurate or may in fact be fraudulent. I think it referred to the location data ecosystem as a Ponzi scheme. I spoke to Amy Fox from Bliss a couple of weeks ago on the Hot Coffee Consulting podcast, and we spoke about how location data is sourced and how location data vendors go through a process of quality control and verification on the location data sets that they process, things like pattern analysis and algorithmically derived verification controls. So it's really interesting. I think clearly a spotlight is being shone on the location data ecosystem, probably for the better. And I think that what has been taken for granted for a long time, which is that we can all get access to quite specific location data signals, and we can use those either in our insights generation or in our targeting practices, is now, I think, being questioned, and probably, to your point on transparency, that's a good thing. Any thoughts on that?
Definitely. Yeah, I think transparency, again, it's one of these buzzwords at the moment coming up a lot. And I think location data is fantastic. And, to say that you can target somebody in and around a certain, shop, restaurant, whatever it may be, in real time to promote the latest offer or to kind of drive that footfall is fantastic. I think where it's can be tricky is actually driving enough scale to actually make an impact on that business. So in reality, how many people are actually going to be around that, location in any given time? So what would be great is if you could potentially combine those signals and actually look at doing some kind of data modeling or, building a more robust profile of users at that time. So that could be potentially where I think it's got some real traction there, rather than, we can target 20 people at any given time and drive footfall.
I agree, and I think that what is interesting about that is that dependent upon the use cases that you want to deliver, the sources, the collection, the segmentation techniques, the verification techniques may be slightly different with respect to how you actually derive the location signals. And so I think that as opposed to looking at these things as completely separate, isolated tasks to be completed, you can look at them as an end-to-end process, knowing the result that you'd like to ultimately achieve, the output, the end game, and reverse engineering then the segmentation processes, the verification processes, and ultimately the data collection sources. Yeah,
completely agree. So on to our last article.
Yes.
So I think this came out about a week or probably two ago now, but it just goes to back up how Google are always looking for ways to innovate and kind of drive more headway in terms of their dominance in market. So this was published on the 6th of March in AddExchanger, simply titled "Google Switches to First Price Auction." So they're moving to a first price auction for their Google Ad Manager product by the end of 2019, which means essentially that all second price auctions are going to be sidelined, and this is how people will be able to buy impressions through Ad Manager moving forward. And there seems to be a lot of great press for Google recently, especially with the rebranding of all products last year. So obviously the likes of the DSP, DBM now being called DB360. Ad Manager is the name of the overall product, which obviously combines the Publisher Exchange ad server as well. I think there was potentially other competitors who have moved to this model already, but I think the key thing is as soon as Google moves to this, it becomes, I would say, the key thing that everyone's talking about out there. Have you got any thoughts on what impact this is going to have, Miles?
Yeah, I mean, look, if Google introduces first price auctions, then it becomes the de facto default for the industry. You're right, there were other exchanges that had tested or rolled out first price auction mechanisms as early as 2017. So, I think this is one that Google's perhaps been a little slow in adopting. I have to put on my economics hat for a second when talking about this, because I think we get wrapped up in some of the terminology without necessarily understanding what it means. So just to very briefly talk about some of the theory behind this, and then maybe how the theory contradicts with what we've actually seen in practice. There is a reason that the vast majority of systems in auction mechanics began life as second price models, and the reason for that is that there is almost 100 years of economic theory that dictates that a second price auction mechanism is actually the best auction mechanism to derive an economically sound and fair result. And that's what auctions are really all about. It's a mechanism to ensure that resources, in this case specifically impressions, are allocated fairly. And what do we mean by fairly? We mean that they're allocated to the individuals that value those impressions the most. So in a second price auction, you're encouraged essentially to bid your true value. You're encouraged to bid your true value because you'll only pay marginally higher than the next highest bidder. And you're somewhat protected from what we call in economics and in auction theory the winner's curse. The winner's curse effectively states that if you've won the auction because you've bidded the highest, then you inevitably have valued the asset, in this case the impression, more than anybody else, and specifically and importantly more than the average. And so you are therefore cursed as the winner in a sense, because you've overvalued the product or the asset that you're looking to acquire. So the second price auction mechanism, because you only pay marginally higher than the second highest bidder, protects you from the winner's curse, and in that sense gives you a greater incentive to bid your true value. And it's deemed to be the most effective auction model because people, given the fact that they bid their true value, are able to win or lose a bid on the basis of their true value. The true value, if it's the highest value, will ultimately win the auction, and they're allocated the impression. So that's why it's considered to be the fairest and the most economically viable auction model. Now, where does that and how does that differ from a first price auction model? Well, in a first price auction model, you pay what you bid. And so if you bid $7 cost per thousand for 1,000 impressions for impression, then you'll pay that value. There's no arbitrage, there's no manipulation of the bid price past that point. And so you're more exposed to that winner's curse. So if I bid $10 for an impression, I'll pay $10 for the impression. It may have been that the next highest bidder was only willing to pay $3 for that impression, and I've overvalued that impression essentially by $7. And I'm not privy to that information, and nor am I able to alter post the auction the price that I pay. And so in that case, you are more exposed to the winner's curse, and the theory goes that because you're exposed to that winner's curse, you'll ultimately attempt to mitigate against that yourself by devaluing or discounting your bid prior to the point of the auction. So I'm willing to pay $10 cost per thousand, but actually because I'm a little bit concerned that I may be overvaluing, I'm going to pay, or I'm going to bid $7 or $8 cost per thousand. Now that can lead to situations where bidders aren't bidding their true value, they're trying to discount their true value. But more importantly, it leads to situations where people that have a higher true valuation of the asset or the impression in this case, don't actually win the auction because they've discounted to a greater extent than maybe somebody else. So that's the theory behind it. It's the theory as to why second price auction mechanisms have led the way. But I think Google's right actually to introduce the first price auction system.
Agree.
And I think they're right for a couple of reasons. And reading through the article, what I'm really seeing and what's going to be very interesting is that I actually don't think it's the second price auction mechanism that's failed. What I think is it's a manipulation of the auction mechanisms that have subverted what is an economically sound concept. And so when you read through the article, what you see is, well, it's because we've got waterfalls and we've got sequential auctions that aren't unified and that aren't happening at the same time, which means that people will be, at some point missing out on opportunities because they can't see the full waterfall and they don't know exactly how the impression clears through the waterfall.
Yeah.
You've also got Google's look back, which is being deprecated as well as part of the unification of the auction system, which meant that Google had an ability to look back over what had been bid and what had been offered and make an executive decision almost at that point to bid just a cent higher than what had been put out in the market. That, I think, was probably too strong in saying it was a fraudulent system, but that was not an economically efficient system. And so what I'm seeing mostly is that the first price auction methodology and mechanism solves for problems and issues that didn't arise necessarily because of the second price auction mechanism, but arose because it was manipulated by other players in the ecosystem.
Definitely. And I think as well, looking at the bigger picture as well, it puts Google in a really strong position, and it is a smart move because there's still a thing to be said about publishers' yield being squeezed more and more and more, and Google still have a stronghold with their ad server. So, in terms of Google doing this, publishers can say, well, this is a great move because it means we're going to get more value for our inventory. It also means that advertisers who are buying media are saying that actually they're going to be getting more transparency into what they're buying. So all round, very smart move. And I think in the long run, Google are always going to be at the leading the charge for this kind of innovation and shouting about it more than others.
Yeah, absolutely. I mean, I think as an economic purist, you'd like to see the Vickery system, the second price auction system, continue. But I think as a realist, looking at the complex world in which we've built ourselves and in which we now currently reside, the first price auction system makes a lot more sense.
Definitely.
Okay, well, thank you very much, everybody, for joining this session of the Roundup. We'll be back in a couple of weeks' time to provide our analysis and our assessment on the next round of news articles and press releases. Thank you.
Thanks.